if the person had invested pre-COVID peak and then seen the 50% fall, today he would have made around 17.38% return.
Hello everyone and welcome to our channel, The Mutual Fund Guys, where we speak only about mutual funds. My name is Samir Gilani and across is Mr. Mahesh Bhagwat. Both Mahesh and I are partners at AMS Investments. AMS Investments is a AMFI registered mutual fund distributor based out of Mumbai. And we currently handle mutual fund portfolios for about 100 plus clients across India and the UAE. I want to actually hand off the episode to Mahesh. In the last couple of episodes, we spoke about all the hidden benefits of mutual funds. And I want to now pass it on to Mahesh, who's going to follow through with this last video. Mahesh, over to you.
Yeah, thanks, Samir. So in the last two episodes, just a small recap so that people are aware of what we did. In one of the videos, we actually talked about how safe are mutual funds, right? The safety part of mutual funds. We said that first, SEBI is an incredible regulator who has created a great process for mutual funds. And the process is such that investors' money is safe from fraud. There is no chance that the money would be lost. That kind of thing has been prevented. Secondly, the mutual fund structure itself is such that 75% of the trustees have to be independent. So not part of the AMC itself, but an independent board of trustees. And thirdly, we said that there is the entire securities that the mutual fund holds is not within itself. It's with a custodian. So it's very different from there is no way that mutual fund people can actually sell the shares and run away or sell the securities and run away. That kind of safety has been created for mutual funds. So investors' money is safe in that sense, right? Correct. The other thing we talked about was that mutual funds have an inherent ability to a great ability to actually give returns because one, they have their own in-house research. They have invested in a lot of research analysts, a lot of fund managers, so that all their knowledge base is available for them for investing in the right kind of securities or stocks. We also said that the broking industry itself, which gets money from the mutual funds for the buying and selling of shares, they in turn have also invested in a lot of research analysts who then look at sectors and that kind of stuff. And then they keep feeding the mutual funds with data. And thirdly, a lot of these mutual funds are actually owned by foreign companies, let's say HSBC or Nippon or Prudential. And therefore, the Indian mutual fund research analysts or the fund managers have access to their own in-house research, which is developed by the foreign entities of the same company, right? So this is we talked a lot about this, but in brief, this is what we discussed. And having done that, I think it is very important today that we talk about, given all these advantages that mutual funds have, what have they given the investor? What have they done for the investor in the last several years, right? So that in terms of returns, what is it that they have generated? And before we do that, I think, therefore, we all agree, and we have discussed this in the past, that the key metric is the rolling return in terms of what kind of returns have they generated for an investor if he had, say, bought at any point in time and then held for 10 years. Because 10 years is what we say is generally the kind of definition for the long run, right? Long term. What is long term? We say 10 years. So if you hold for 10 years, if you buy at any point in time and hold for 10 years, what kind of return would you have got in the past? Right? So
let me take one minute to just explain quickly, Mahesh, for the viewers, what does it mean to invest at any point in time, right? So most returns that we look at in stock markets or in mutual fund, they are point-to-point returns. So they look at the return at one point in time, say January 1st, and they look at the investment on December 31st, right? So the point-to-point returns. And these are the returns that most mutual funds publish in their offer documents. Not offer documents, but in their subsequent documents. Rolling returns that you're talking about essentially means, obviously, nobody will invest on January 1st every time, right? And sell on 31st December. We invest at different points in time. Some people will invest on Jan 10th, December 3rd, September 15th, August 31st. It's just various, right? So you're trying to say that if you had invested at any point in time in the year, and held on for the next 10 years,
Yes.
what would be the average return? And those are called the rolling returns
Yes.
for an investor.
Yeah.
Those are actually the more practical returns that we speak about, because you never invest on day one and exit on day X. You always have sort of investments at a different points in time in your life.
That's true. So it is like saying that if you were an investor and bought at any point in time from January 2000 onwards, that means in the last 25 years approximately, then, and you held it for 10 years, what was the average return that you got in that period of time, in those 10 years? And the answers are quite spectacular, actually. The last 10 years, I mean, if you had bought at any point in time and held for 10 years, that is the 10-year rolling return, average is around 11.88%. That's the kind of return that it has generated, right?
Average. So you could have
On
more
an average,
or less.
right?
Yeah.
So because we are saying average, we have to also talk about the minimum returns that has happened at any point in time if the client or an investor held for 10 years. And that minimum return is around 5.65%. That's the minimum return, right? So it's not worse than an FD at any time at any point in time if you bought and held for 10 years.
For 10 years.
And the maximum actually is 17.75. So that's like a big return, right? 10 years compounded 17.75. That's the max return an investor would have got in this last 24 years. Right. So this is the kind of return that the mutual funds have been able to generate. And remember, in the period from January 2000 onwards that we are talking about, there was one big IT crash. Correct. For the first 3 years, there was a big crash in the markets. Then there was this big crash when the global financial crisis happened. Correct. We are all aware of that. So in the 2008 to 2009 period, markets fell by 60%. So in the same period of time, we have seen all these kind of falls. We have seen the COVID fall, where the market fell almost 50%. And despite all this, this is the average return. This is the minimum return that I talked about, 5.65%, and the maximum return of 17.75% on a 10-year rolling basis. Mutual funds have been able to deliver, right? So this is spectacular. And this is all because of the kind of effort that they put behind this.
Put in. No, that's the best part about mutual funds, right? I mean, you literally have to do not much to get those kind of returns. Your work is sort of to stick to the process, remain invested, don't panic. And then these 10-year rolling returns are phenomenal. 12% returns a year for 10 years is a astounding number in my opinion. Let me give the viewers an explanation as to what 12% does for you over 10 years, right? So if you take investment of 1 crore rupees, okay, and you let it grow by 12% or 11.88% over, 10 years, that 1 crore becomes 3.1 crores, right? Or if you put 10 lakhs, that becomes 31 lakhs. It's a significant jump in your net worth over a period of 10 years when the effort that you've put in is quite minimal.
Yeah.
Where you selected a fund based on your risk reward and you've selected a good AMC and you've just put the money in and your work is sort of done because the fund manager and his research team and analysts take care of the investment process. You don't have to do anything beyond that. So if your money has gone up by 3 times in a matter of 10 years, it's a very, very, very phenomenal number. And you mentioned one thing, Mahesh, you mentioned the fact that the minimum return that a person got, minimum, was 5.68%. 5.68% is post-tax is better or almost equal to an FD rate if you look at the last 10-year FD rates. Right?
Correct.
So you perhaps were in a situation where you never really lost any money in that whole process of 10 years. Okay. And even if you did not make as much money as say 12% or 17%, you still made an FD return comparable of 5.5-6%. So, I mean, this is of course all past returns. They are not sort of applicable for every future return, but you can say for a fact that the pattern of the pattern of returns that mutual funds have been delivering over the last 10 years, okay, if things continue to remain the same in India and if we sort of grow by 6-7% a year, given whatever is going on, I think that returns will probably commensurate, and they will come through.
Let's not even get into that. The past at least is very clear that this is how it has been. So unless we see a big change in the GDP growth of India in terms of a big fall in that? Or if you don't see any kind of disasters happening in the rest of the world, then we could basically assume that nothing drastically is going wrong within India, right? In fact, if anything, it is probably going right, which means that what has happened in the past could, and we can always say could replicate, but we can't say that this will 100% happen. All that is not in our hands.
Yeah. The bigger point that you're trying to make is that, look, the mutual fund industry itself is structured in a way which can deliver these kind of returns. They have the resources to themselves. The ecosystem is quite robust now in India. And these returns have been, they have been returns. These are factual returns. These are not made up returns. And of course, we can't predict the future, but if all else is the same, then there's no reason why this can't continue.
Correct. Absolutely right. And actually, another point, is somebody who listens to this video might say, but at 1 10-year holding period, I would have got only 5.65%, and that's not very good. But then the counterpoint is, and we'll talk a lot more about this in a future video, I'm sure. That is why we almost always say a large portion of your investments should be through an SIP, a monthly investment. So you're not going to be that one unlucky guy who bought in at a point in time and held for 10 years and just got 5.65, right? You would, in fact, be, if you do an SIP, then in all likelihood, the returns that you would have got in the last 24 years in any 10-year rolling period would have been closer to that average of 12% or probably even more. So SIPs have that advantage. And so nobody just invests at one point in time. They don't put all their money at one go. So I don't think we have to really worry about that one minimum return, which was at 5.65. Most people would have got probably closer to the average return in the last.
Yeah, like you said, it's an average, right? So some people would have got that, some people have got lower, some people have got higher. But generally speaking, I think the point of making that the SIP route would have taken care of those volatilities.
Yes.
And you would have made close to average of 12%. And again, I think we have to understand one very important point. In these last 10 years, since the returns we are talking about, a lot has happened to the world.
Yeah.
There was the IT boom crash that happened. Then there was September 11 that happened in 2008.
Okay. Yeah.
Very big. These are big events. There was in 2004, I believe, in India, there was an election that was not 2004, sorry, 2000.
That was 2004.
2004. Yeah, 2004. So there were lots of ups and downs in the market. And I'm saying in 2004, the market actually went up. So if you were not invested, for example, and you were sort of waiting for the right time to invest, etc., you would have lost on a very large gain in the market, which came in one single day. Whereas most mutual funds at that time, by compulsion, have to be invested anyways, minimum 65% in any equity fund, right? So you would have been invested in equity and you would have seen that upside. So the point is that in the 10 years, the amount of news events that have happened, etc., and you still managed to give you 12% returns without almost any effort on your part, I think is incredible. And this is the point we're trying to make. There are so many hidden benefits of mutual funds, not many are spoken about. And this is one of them.
Another thing that is very important, and in my experience, and I'm sure in your experience too, we would have all heard of this question asked, but abhi market to bahut upar hai, or things like that. So one of the things that we wanted to dispel through this video, just by an example, is that, what was the high that the market made? That was somewhere around January 2008, before the global financial crisis. We made a high,
around
right, in the market.
6,500 on Nifty, I think.
Yeah. And in that 1 year, the market fell down to 2,300 or 2,400 in terms of Nifty points, right? So basically 6,500 odd as the high, 2,300 means 4,000 points, almost 66% was the drop in that year. Now, let us say you are the unlucky person who decides to put all your money in the market in January 2008 after feeling a great sense of FOMO, right?
Yeah.
You missed out on the entire bull run and you felt this is the time to go all in, and you bought, right? And there's another guy who said, no, the market is too high and I'll wait, and then bought sometime in the bottom of 2003 when the Nifty hit 2,300, let's say that
in the bottom of 2008, you mean?
At the bottom of 2008 when Nifty was around 2,300 points or so. So we are talking of two extremes. not
Yeah.
a real life scenario.
One very lucky guy, one very unlucky guy.
Very unlucky and very lucky. Now let's talk about that very unlucky guy. If he bought, he would have experienced pain, no doubt, no doubt. But if he held on till now, then what is the kind of return do you think he would have made?
I think close to 12%.
Yeah, it's 11% compounded, right? It's 11% compounded despite being the unluckiest guy in terms of his investment. He still would have made 11% compounded returns, okay, till date. And
the person,
obviously, the guy who was the luckiest guy and invested at the low would have made around 14.7%. Nothing
so it's not
earth-shatteringly
much.
different. Yeah, nothing
Okay.
earth-shatteringly different, right?
But here's the big point that you're trying to make, right? So 11 and 14% is a 3% difference, I understand, right? But if you stretch this period to another 10, 15 years more,
yeah,
and both these individuals are remaining invested,
yeah.
So by 13, 15 years from now, they will converge, as in there will be some difference, but it'll be minuscule difference. Might be 13.5 versus 14.25, you know. So the point is even actually better now, because no matter when you invested, even at the top or the bottom of the market, if you held on for 15 years, your returns from an individual who timed it perfectly would not be very significant, because the time spent in the market was so large that the difference between you and him is getting narrow and narrow and narrow as time goes ahead. So I think that's just a very good point.
It's a very important point, because this is the kind of questions that we keep getting asked. Like, is the market at a peak today? Do you think I should wait? And the answer is that I think very few people can, with any kind of guarantee, say that this is at the peak or this is at the bottom or this is fairly valued or not fairly valued. None of us can really generally say that. We can only advise that, look, this is the past data. This is how it shows, right? Even if you bought at the wrong time and you were timed it in the worst possible manner on the worst possible day, you would still be okay as long as the time horizon of your investment is large enough, right? As long as that is large enough. And that's the kind of point we are trying to make by past data. There's nothing else. It's just the past data. This is what it is saying. And it's the same with even the pre-COVID peak, right? If the person had invested pre-COVID peak and then seen the 50% fall, today he would have made around 17.38% return. And if he timed it perfectly to the bottom of the COVID thing, he would have made around 27%. So that's a 10% difference compounded. But
that's a very short period of time, yes.
But that is because it's a short period of time. In the next 10 years, if both invest, then both remain invested, then both will converge to a more reasonable difference, right? And that is very important. Initially, it looks like it makes a big difference. The point of investment, the day when you invest makes a big difference in the first few years. But as the time progresses, the difference reduces to a more manageable number. So as long as you have a large enough time horizon for your investment, it just doesn't make a difference as to when you invest, provided you have the ability to withstand the volatility in between. I mean, that's the only thing that is required. Right?
Yeah. And I think this is just a point which is, just to summarize in a sense, is if you are investing in mutual funds, either through lump sum or SIP, although we always recommend SIPs, even if you say you bought a lump sum amount, just be prepared to be invested for a long period of time. So don't consider your mutual fund investment as a trading investment or something that you want to buy in a short term for a short term goal that you have maybe 2 years down the line, 3 years down the line. So if you have short term goals, then having a high risk, having exposure to high risk equity funds is not suggested. But the point is that if you are investing in mutual funds for long periods of time, then honestly, with the past data that we've seen, when you enter the market has little significance. There will be some significance, some difference, but it won't be enough for you to really cry over.
It wouldn't matter.
It wouldn't matter,
yeah. So I think this is the key lesson, I think, that we've learned from the data that we have seen in the past. And that is what we wanted to convey to our viewers through this video.
Yes.
And maybe somebody would listen to it and not wonder about whether to invest now or not, right? That is the kind of lesson we wanted to let people have. If somebody wants to get in touch with us, then you can write to us at hello@amsinvestments.net. And the other contact details are given in the description below. And we will come back soon with another video on mutual funds, because that's what we are, the mutual fund guys. right?
Yeah, and if you like our content, you can subscribe to us. If not, don't subscribe, but continue hearing us. We definitely would like to educate each one of you about mutual funds, and that's our endeavor, and we hope to continue doing so. Thank you so much for watching, and see you guys next time.
Bye.